For those who don't know, there's these new companies or protocols or whatever, however you want to describe them. One's called Fuji Money and one's called Sovereign Zero Protocol. They're basically trying to create a way to where you can deposit your Bitcoin as collateral and borrow dollars at 0% interest. It's basically an over-collateralized Bitcoin-backed stablecoin. I know we've exchanged comments about this on Twitter, both publicly and privately. What are your thoughts on those technologies? Do you think they can work? Do you think that they can't work? And what are your thoughts on, I know one's built on Liquid and one's built on RSK. What are your thoughts on that as well?
Totally. And look, this is a really interesting topic. I'm really glad that it's becoming more to the forefront. Bring it back to our toxic maximalist conversation before. What I think is the glaring hole in Bitcoin I guess you call it cultural awareness, is that we do need to build, for censorship resistance, we do need to build financial applications that give Bitcoin optionality. Because burying a cold card in the back of your backyard for 20 years and then giving it to your kids, that's great. But that's not the end result. We need to be able to do more with it. Now, as you mentioned, basically what you're alluding to is getting into a DeFi basis. Now, we can all debate the term of DeFi, how D is it? There's always going to be centralization vectors of these things, but there's also trade-offs. Now, a big critique I've had of Ethereum is that if your main purpose is moving stablecoins around, whether it's in borrow or collateral, Circle, as we saw with Tornado Cash, can freeze that instantaneously. Do you need fully decentralized rails to support something that can get frozen anyway? Yeah, probably not. So the trade-offs of less centralization, if you're building more centralized apps, then having a less centralized base is probably okay. Now, when it comes to the DeFi systems, as you mentioned, there's different variants, right? Different chains, different side chains, different designs. There's things like drive chains, which is basically an altcoin node. The trade-off there is we require a soft fork for Bitcoin to make that happen. And that's going to take politically many, many years. Does Bitcoin, do we need this stuff? That's another philosophical question. But drive chains, the trade-off is we need a soft fork. It's going to take a long time. I'm skeptical we're going to get the momentum on it. I'd love to see it because I like competition. I'd love to see it happen, but it needs to happen. There's space chains, which I know a hell of a lot less about. I need to do my reading more on it by Ruben Simonson. Now, these things are similar to drive chains, different trade-offs. Both of them, I believe, have something to do with I know drive chains are blind merge mining, which puts the miners into control. You've got like a 3-month withdrawal process. Space chains, as I said, I need to do more work on to understand them, but similar system. Basically, the mining, it basically puts the control of peg-in, peg-outs to miners. Then there's the other option, which is things like Liquid. Now, Liquid is a federated sidechain. What that basically means is that you've got 12 exchanges. Is it better than trusting one exchange? Yes. Is it better than trusting 100 exchanges or 100 different entities? No. But is it more decentralized than one? Yes. So the other one, actually, you can argue, Coinbase and Binance, they are extensions of Bitcoin, fully centralized, but you get optionality. You get all the DeFi services, they may not be DeFi, but you still get to access different services. So Fuji Money, if I understand correctly, and again, I haven't spent too much time digging into the docs. I understand the Ethereum side a lot more, and what I know is that those principles have been borrowed and redeployed on Liquid and Sovereign. So obviously with nuances and tweaks, but the same principles apply. So on Liquid, you've got a federated sidechain. You are trusting a multi-sig system. There was a bit of a debacle, it would have been maybe a couple of years back, where it was discovered that actually that multi-sig was about 4 people at Blockstream that had access to it. So, there's trade-offs here that you are essentially sacrificing. Drive chains and space chains are more decentralized because you're putting control with Bitcoin miners. Basically, Liquid is a completely separate sidechain. I'm personally not a huge fan of Liquid. I think it's kind of bastardized what a sidechain is. I don't think it is even strictly a sidechain. I think it's a misnomer. But it is another option that exists. You've then got something like RSK, which is also one of these merge mine systems. But the system, basically, you can peg in your coins and peg them out. It uses BTC as gas. However, you essentially have a federated peg. So along all these different spectrums, there's layers of centralization. Once you go into the DeFi protocols themselves, generally speaking, the Oracle is going to be centralized, which I'm actually not opposed to, because I don't believe the Oracle situation can be solved in a decentralized manner. The only way you can actually solve, in my personal opinion, the Oracle problem is by essentially having a robust one where you pull multiple feeds and you have checks and balances and things like that, moving averages to kind of slow and make it more expensive to attack, and having those kind of triggers. It's a lot of engineering, but doing something on that vein is probably as close as you're going to get. I think I'm very skeptical of all the chain links and the bands and all these types of things. I'm just not. I don't think they're cryptographically secure. In fact, I don't think they are cryptographically secured in any way, shape, or form. But again, look, you're always going to have centralization vectors. The other big risk is currency pegs. So DAI is a good example from the Maker protocol. They broke their peg to the downside and to the upside. Their solution at the end of the day was plugging USDC in and backing it 1-to-1. Now, that's obviously got centralization vectors. Someone turns off USDC, DAI is done. So that's another trade-off. And if you get a stable coin that has a soft peg, the likes of which Fuji and what's the other one? Sovereign and Deploy.
Zero.
Yeah, there's no question. They may well work until you get big enough that there's an economic incentive to make it not work. So there's always challenges here. And if you get a currency peg big enough, there's going to be a George Soros come along and say, I'm smarter than you are, and I've got more capital than you do. I'm not saying they can't work, but they need to be tested at scale. There's an enormous risk there on the peg. There's centralization vectors on the oracles. There's then federations and things on the peg in, peg outs. And again, all these risks compound up the stack. So it's one of those things where I'm very glad to see competition. A blind spot for Bitcoiners is that because they just said Ethereum's a shitcoin, they never spent time watching the DeFi ecosystem evolve, so they have a lot of blind spots on where risk shows up. They haven't seen these mechanisms before, and there's a fear they're going to make the same mistakes and not understand the risks so they didn't experience it. There's also a lot of narrative trust in Liquid because it's Blockstream. That's misplaced, right? There's still exchanges. They have the exact same problem I described with Proof of Stake. Same problem, same exchanges, same 13 validators, same problem. They can halt and freeze and take your money. It can happen, right? So people need to understand these risks. I think Bitcoiners have a blind spot to it. I also think that competition is required, and toxic maximalists should be, in fact, promoting maybe not the issuance of shitcoins, but also respecting that you can have pseudo equities, right? Someone has to pay to build this stuff, and if you build a protocol and you issue a pseudo equity, if you do it as a security, a registered one, what's the problem? Like, what's the problem? People can make their own risk decisions, especially if they're properly registered securities. People complain about ICOs. Well, don't do an ICO. Do an actual properly compliant security offering and allow people to invest of their own accord. You may think it's a shitcoin, but this guy may make a whole lot of money. And empirically speaking, a lot of these things have, in fact, given remarkable returns, well over and above Bitcoin. Sure, they get wrecked in a bear market. Bitcoin got wrecked against the US dollar as well. So being reasonable and actually accepting that there's going to be competition, promoting proper pseudo equities, I think, is a good path to take. And actually do it properly and allow this infrastructure to get built out because you need funding. You're not going to get this through donations, and that's why RSK is taking so long to get built out. It's why Fuji is taking so long to get built out. And they're in a position where they can get funding from centralized entities. So there's trade-offs, there's risks. Bitcoiners, I think, have a big blind spot because they didn't want to look at DeFi. So we're going to have to go through and learn the hacks, the oracle breaks, the pegs. We're going to get wrecked. Bitcoiners are going to get wrecked because they never studied what happened over there on the other side of the fence. So it's going to be a fun process. We have to go through it. We need to go through it. And, there'll be opportunities and wrecked all the way through.